Well, let's go live to Shanghai now, where I'm joined by Ken Curtis. He's a founding partner of Themes Investment Management. He's a former director and vice chairman of Goldman Sachs Asia. Thanks for being there, Ken Curtis.
Thank you, Tony. Pleasure to see you.
Thank you. You've written that the crises in Greece, Portugal and Ireland were mere sideshows, and now we're moving to the main event with the crisis in Italy. Tell us why.
I think that's very much the case. The other countries are small, they're sort of, if you like, manageable. And you can see already, Tony, now that we've moved to focus on Italy, no one's even talking about Greece anymore, that they can't find a prime minister, that they're going to be meeting again tomorrow, that this prime minister will only be prime minister for a few weeks until elections early next year. Greece, in a sense, has become a sideshow. Portugal is not really on the agenda. Ireland, they're sort of already roadkill, if you like. But the big event now is Italy and perhaps later Spain, because together these two countries have government debt of $3.5 trillion. That's almost twice the economy of France that these two countries are going to have to juggle in these extraordinarily complex and turbulent times.
Well, Ken, explain for us exactly what it meant for the Italian economy and for its financial system when the bond yields, the 10-year bond yields, pushed through this 7% mark right up to 7.42% yesterday.
As they go up to those levels, and you're thinking about this government having to refinance hundreds and hundreds of billions of euros in debt, you then start to make the calculation of how much that's going to cost. For example, Tony, next year alone, Italy has to refinance 300 billion euros of existing debt. And so if the interest rate's at 7.5%, that's going to cost them close to $24 billion or euros just to finance. And as that continues, they will simply not be able to generate the growth in their economy to carry that level of financing and debt servicing, let alone paying back the debt. In fact, today, late this afternoon, in European time, the European Commission announced that the European economy has come to a stop. They've chopped their forecast for growth for next year down to 0.5%. And the Commissioner for Economic Affairs in Europe said that the economy today is facing a very gloomy prospect.
Yep, the markets, as you put it, Ken, are relentless in searching for weakness. They've found a critical weakness in the third largest economy in Europe, that's Italy. And so I guess we really have to ask whether they're headed for a sovereign debt default.
Well, I don't think Italy yet is anywhere near a sovereign debt default. I think if the situation continues to slide, if we continue to have very little visibility on how they're going to get out of this situation, little visibility of how the European Union is going to handle this, little visibility of how the European Central Bank is going to navigate its way through this, this crisis inevitably, and very unfortunately, I believe, is going to get dramatically worse. And were Italy to get pushed to the brink, were Italy to be pushed to where Portugal is or Ireland is today, or heaven forbid where Greece is, it is just too big for the French and the Germans to carry on without undermining their own finances. And so then we would go from a very complicated European situation that has collateral damage for the rest of the world to a global financial crisis.
It's interesting, isn't it? Because, and you use the word convergence here, which is what the EU was set up for in the first place. But the convergence essentially means, in this case, that countries like France are actually holding a tremendous amount of this Italian debt. So they're at risk too if Italy fails.
That's correct. If you think of it, the Italian banks are holding very close to €500 billion of Italian bank debt. In addition, the French banks own banks in Italy, plus they've lent money to the banks in Italy and to non-government organizations and companies in Italy. So that is why you have this tremendous pressure on the French government from the French banks to get this European bailout fund put together quickly, so that it can be brought into gear and used to handle what is going to be this inevitable crisis. And yet tonight we have we have news coming out of Europe that this bailout fund has again been stalled with huge difficulties in putting it together and great conflict within Europe. There's no consensus among European policymakers what to do, how to do it, when to do it, and what has to be done. And that, of course, that constant chatter is making things even more unstable.
Is there enough money in all of Europe, I mean, to actually prop up the Italians and the Spanish economies if it came to that? And what would it actually cost? I mean, you'd very likely see a run on the banks, wouldn't you?
Well, I think the two trigger events here that the politicians and the bureaucrats have to be handling terribly carefully are one, those interest rates, because if Italian rates were to continue going up, then you know, we go tilt. Or secondly, there's a run on the banks. We've seen in recent months in Greece that the Greeks are taking their cash out of the banks, they're walking with their feet, they're voting with their feet in a sense. If that starts to happen on a wide scale, then the lights go out and we're in huge trouble. I think in the end, Tony, we are going to see the U.S. Federal Reserve very deeply involved in this and providing virtually unlimited credit facilities to the ECB, which would then provide those facilities to European banks. I think you will see the IMF involved in this up to its eyeballs. This, Tony, this is the big one.
What does all this mean for our region? And I guess we're talking about the big Asian economies, China in particular, and let's also factor in China in terms of a European bailout, because the Europeans are expecting big things from China. Will they get it?
I think the Europeans came last week to China and with half-baked ideas. They hadn't thought them through. The Chinese said, well, maybe we would lend you money, but if we did, we'd lend it in our own currency. The Europeans said, well, we hadn't thought of that. They asked, what collateral would you put up? What guarantees could you provide? I think we are very far from the Chinese signing a blank check to give lots of money to the Europeans. Plus, in this country, there's huge opposition to it because many people in China believe that this country is still poor. Its per capita income is about 1/12 of what the European per capita income is, and a lot of people can't rightly figure it out how they would come to the defense of the Europeans. I think what this means is that Europe is already in a recession. I think that this is going to have spillover effects, of course, on China on the export side. It's going to have spillover effects on the lending of European banks throughout Asia. And as they pull back, of course, that puts companies under pressure. I think that we also have other areas of concern in the world economy. The U.S. economy is growing, but barely. Japan's in difficulty. So I think the next 12 months, Tony, are going to be months that are very troubled for markets. They're months where I think people have to be extremely careful with how they manage their money, not to find themselves all of a sudden sideswiped by political events, by economic events that seem to come from nowhere. I think that this is the big test for the management of the world economy, and we're going to see if the leadership that we have at the moment is up to it. What we saw in Cannes at the G20 meeting last week was that we need a lot of progress in the leadership and management of the world economy before we can have the confidence that's required to move ahead with some serenity.
Yes, at the risk of appearing parochial, what impact do you anticipate there would be on the Australian export economy, and particularly with China? And I guess the real question here is how much is China protected by its own massive internal economy?
Well, the Chinese are very pragmatic and practical people, so they see that America is going to be growing slowly. There's more protectionism, however it's called, or disguised. There will be more of that in Europe. Japan is on its back. And so the Chinese are turning every day more to releasing domestic demand, and that's what's going to be driving the economy. If we had the latest Chinese numbers out a few days ago, the economy grew by about 9%. But consumer spending grew at 17%. Imports are running ahead now. They're growing much faster than exports are. So that's where China's economy is moving, and it's going to have to move there more quickly, I think, than the Chinese leadership at the moment currently expects.
So, briefly, Ken, just to sum up, we're nearly out of time. But what impact would you expect then on the Australian export economy, would it still be propped up by this internal market in China?
Well, China is going to continue to be a big driver for Australia, but the overall demand for natural resources is going to be weaker in the next 12 months, and so their prices will come off, and also the volumes will be off, and I think that means a weaker Australian currency and a weaker Australian stock market and a sort of pause until the Chinese come through this, and I think by the summer of next year into 2013, China will have hit the bottom and be coming back up again.
Ken Curtis, we'll have to leave you there. Thanks for joining us from Shanghai for a change. It's good to see you.
Thank you.